Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Mateo, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well, so go check us out there. I've been doing the stock market thing, Lisa, for like 40 years almost. I still have no idea how this whole thing works. I mean, look at it, Goldman Sachs, Morgan Stanley, B of A. They had what I thought were really pretty darn good quarters in a world where we're not really sure what's going on. So, of course, all the stocks are trading down today, so I can't figure it out. But our next guest is an expert. She knows what's going on. Alison Williams, Senior Analyst. She covers all the big banks and all that kind of good stuff for Bloomberg Intelligence. She joins us here in our studio here. So as you looked at, again, we've had 2 days of the biggest banks, Alison, and you've been covering these guys for a very long time. You've seen it all come and go. How are the big banks, investment banks, doing this quarter?
Well, you mentioned you've been doing this 40 years, and you've never seen a quarter like you saw at Goldman Sachs. Equity trading, record trading. The really standout for Goldman is they're the biggest in equity trading. They are the biggest in M&A, and they had the biggest jump. So really solidifying that leadership. The equity trading up 36%, prime brokerage, cash, derivatives. We talked about the fact that we saw record trading on the equities exchanges this quarter. We certainly saw that come through at the banks. M&A, Goldman talking about the fact that announced volumes are up 30% and we're running above average now. So that bodes well for the future. And I think, in terms of the stock reactions that you referred to, I think, so as I said, we can see that there was a lot of strength in the exchange volumes. We could see that, IPOs had rebounded the last couple of months, even though, it wasn't in analyst numbers. I think there was some visibility there. So I think in terms of what the stocks are reacting to, Morgan Stanley had a really strong quarter, beat everything, but just not as good as Goldman. And I think people are looking at that equities trading. Morgan Stanley was in the lead for a few years, and now Goldman is really pulling ahead.
Yeah, and I see, because the whole morning I was like, why is the stock lower ever since the bell opened?
It is. And by the way, wealth is the business that people watch for them. The wealth flows, the numbers were good. So again, what are people worried about? So it could be the market share. Morgan Stanley did point out that they had a record quarter in Europe. They say that they're gaining share. We'll see what happens when the Europeans report. And Asia, the other thing is capital. So buybacks, better than expected at Goldman, weaker at Morgan Stanley. And keep in mind, we've seen these big moves in the financials. A lot of that is really about the capital return story.
Well, and the consumer resilience, we look to Bank of America for that. So did you see it?
We did see it. Okay. And I think that is what we saw in the quarter. So net interest income as well as charge-offs. Those are kind of the two, bank business lines, if you will, that are most revolving around lending and consumer health. And, interest income, it was like a little bit soft in the quarter, but the outlooks are fine or better. And credit coming in line to better than expected. And the reserve building really telling you that, look, there is some conservatism baked in for some uncertainty in the second half. But in general, things are improved.
When President Trump was elected for this second term, almost immediately people are saying, buy the banks. They're going to be the beneficiaries of reduced regulation and reduced oversight. Has that happened? Do we still expect that to happen? Is that still part of the story?
I think, we're on a journey, I guess, if you'd say. Isn't that the current rhetoric? But I think that's why the buybacks were important, right? So one of the things that people are very excited about in terms of reduced regulation is holding less capital. Yep. Returns on equity are going to go up mathematically. There'll be more money to return to shareholders. Goldman had really that leading dividend increase that we saw after the stress tests, buybacks better than expected. And meanwhile, we saw the weakness at Morgan Stanley. Wells Fargo, another one. That was another bank that investors were really optimistic about after the U.S. election. They did get the asset cap removed, so I think there's a long-term overhang over the stock. But in the current quarter, people were a little disappointed. Like, they didn't give any guidance on buybacks. They didn't change their return target, and it just might be that that's going to come, but didn't get the news yesterday.
Private credit. Where do banks stand with private credit? You had JP Morgan say they would invest like $50 billion in private credit. So what kind of example does that set for the industry?
I think and Jamie Dimon also, I think, made some comments around private credit that I know were picked up in the headlines. I think that, again, private credit, it's been sort of, the hot item for us all to talk about. But, maybe, and we are seeing, continued strength. I think we do expect continued fundraising. But, I would say nothing really stands out this quarter from any of the banks.
Yeah. Lisa was asking before we went on the air, can she ask you about private credit? And I said, you can ask Alison about anything, and she'll have an informed opinion. That's why I'm going down this alley. Strong results out of the U.S. big banks this week. We're going to hear from the European ones, I guess, next week. When is the European Union going to say, if we ever want to compete in global finance, we have to allow merger deals? Is that even on the table?
I mean, I think that it does come up, and I think we have heard regulators talk about it, like, oh, yes, we should do something. But the question is, everyone wants to be the one, the victor. They want to be the one, where their champion is the buyer. And so I think that's, where the rubber meets the road, if you will. It will be interesting, to your point, when we see those Europeans report. Again, Morgan Stanley, record quarter in Europe. They said the first half, they called it extraordinary in Asia. Obviously, we know Asia is a lot of diverse parts, but the Europeans like UBS have tended to be stronger there. So if this quarter we don't see them participate and kind of follow that Morgan Stanley lead, that will give us further proof that they're actually losing share in their home market, and that should be a little bit more concerning.
I mean, you could argue that the horse is already out of the barn. They've missed it. I'm just thinking 20 years ago, it was so much more competitive. They were so much more competitive. I remember just going up against some of those big European banks, and now it's almost like an afterthought. It's just amazing how that's evolved. Alison Williams, thank you so much. Appreciate that. Alison Williams, she's a senior analyst, covers all global financials. If you have any question on anything on global Wall Street, you can just go up to Alison on the street and ask her. She'll have an answer for you.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence. I'm Lisa Mateo alongside Paul Sweeney. We do have some news out of Hewlett Packard Enterprise. So it's creating this new strategy committee, turning to Elliott Investment Management for help with this. Here with all the details and to break it all down for us is Jin Ho, Bloomberg Intelligence Senior Technology Analyst. Jin, thank you for joining us. I want to start with, of course, who is involved in, who is part of this committee?
Yeah, sure. Thanks, Lisa. So it is a hand-picked board member by Elliott Management. Keep in mind, Elliott is an activist investor that has a 10% plus shareholding of HPE. I believe they made their position early in this year. And who they appointed was Bob Calderoni, who has done similar type of deals in terms of taking companies private, or more importantly, operational streamlining. So any changes, I think Elliott is going to try through Bob to affect a lot of changes at HPE.
Would you just remind us what HPE is today, number one, and number two, what do they need to fix to move this thing forward?
Yeah, hey Paul. So HPE is one of the leading enterprise IT infrastructure vendors. They provide servers, storage, now a bigger networking presence with the Juniper acquisition. And actually, quite frankly, there's quite a bit to fix. From an operational standpoint, they fumbled the first quarter results by mispricing their server business, and it seems to be reconciled now. but it flags some of the operational issues, number one. Number two, they have made a lot of M&A that just didn't create the synergies that they had hoped. So, they did hire the former HP CFO to streamline the financials. And with the Juniper merger starting underway, I suspect that the new strategy board it will try to find more operational synergies between the two networking businesses.
Jin, can you dig more into how it's under pressure, kind of like lagging behind Dell in growing AI? What kind of pressures are facing in that market?
Yeah, so if we think about AI, right? HPE actually owns Cray, and we think about high performance compute. They are the market leaders there. They weren't able. HPE has not been able to transition that Cray business elegantly to the AI side of things. So let me put this into context. I think HPE should be on track for about $3 to $4 billion in AI sales this year, possibly 4 to 5, right? Dell is going to be on track for about $15 billion this year, and Supermicro is probably on track for about $20 billion this year. So, they've lagged on the AI front, even though they have some of the leading technologies in high performance compute. That's an area that, could be fixable under the right hands.
One more here before we let you go, Wooj, is just, you mentioned they own Cray, they own Juniper. If I'm Elliott Management, am I thinking about maybe they could be selling or spinning off some of these businesses to enhance value?
Well, Bob Calderoni used to be on the Juniper board, and they actually helped with the operational streamlining of Juniper, right? So I think you want to keep Juniper. Okay. Right? There are other aspects of the networking business that you could probably parse away, right? The Cray business you'd want to keep because AI is going to be the growth engine and also help you transition to the enterprise AI.
All right. Jin Ho, thank you so much for joining us. Jin Ho is Senior Tech Analyst for Bloomberg Intelligence, based down there in our BI offices down there in Princeton, New Jersey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get back to a story that crossing the tape over in Europe earlier this morning. Diageo CEO Deborah Crew steps down. What's going on there? Duncan Fox, Bloomberg Intelligence Senior Consumer Staples Analyst, joins us here. Duncan, what's happening at Diageo?
Well, I suppose the performance of the shares and the organic growth and sales, etc., haven't been very good for the last couple of years since she became CEO. So there was sort of rumours, bit of pressure that she should go, but it's ironic that she has outperformed the other spirit companies in Europe over that time period. So I think it just shows you have to show something to shareholders, not to sort of have rumblings of discontent in the background.
So how long has she been there, and then who's stepping in for now?
Well, at the moment, she's been there 2 years as CEO, and she was sort of going to take over from the previous CEO, and she'd been there about 6 to 9 months before that to sort of get to know the business. Temporary CEO is going to be Nick Jingyang, who's the CFO. He's only been there 9 months, so it's quite clear they now have to go out and get the right CEO to take them to the next phase, which essentially is getting through tariffs. And now that they've got rid of the excess inventory in most of the countries around the world, actually driving organic growth again.
All right, looking at the stock over the last 5 years on a compounded annual basis, Diageo down 5% per year. And when you put that against the FTSE, up almost 11% a year, you see the real underperformance there. But if you just look at it relative to the FTSE All-Share Beverages Index, that's down more than 2%. So it's not that bad relative to the industry, but it's a tough industry. Duncan, are there growth drivers for the spirits business?
Long term, yes. I mean, in the short term, you had obviously the excesses after COVID, where shutdowns of clubs and bars really hurt. So they had a nice benefit when everybody restocked. But then interest rates went up, inflation, that really killed people going out. And that's really the problems they've had to get over, and subsequently you had tariffs in China, 39% of cognac, not actually affecting Diageo, but obviously President Trump, which I heard you talking about just earlier. I could not tell you what European tariffs will be. We know the UK will be 10%, so it's good for Scotch, but I have no idea what it's going to be for anything else that they've got within their portfolio. So, this is the problem. It's very difficult to pin down your earnings estimates. And they've obviously been falling for about 18 months, 2 years now, to really say that the recovery is coming, because we just don't know whether it's going to be 200%, which was rumoured at some point after April, or it could go down to 10. It really is up in the air at the moment, and that's the problem for the whole spirits industry, I'm afraid.
Yeah. Now, Duncan, you mentioned tariffs, but also there's a lot of stories we've been talking about people drinking less. I mean, does that play into this as well?
Please.
Except for Paul.
Well done, Paul. We need you to drink a lot more, by the way. There's a couple of issues there. I mean, it's true that the Gen Zs have, at some point, were sort of abstaining a little bit from alcohol, and I think people took that a little bit too fast, assuming that people were going to switch to cannabis-based beverages or something else. But what is happening is, what's happened for the last 20 years is that people are drinking less, but they're drinking better. So and that actually plays into the spirits portfolio better than probably beer, to be honest, because you'll probably have an expensive cocktail whilst you're out with friends rather than 4 or 5 beers. So it's the way they've set the strategy up. Every company I follow has that as their strategy. They push you towards the premium brands. But to do that, you need inflation to be tamed. And that is still not a guarantee, just as we sit here today, as we saw from US and UK inflation today, US yesterday and UK today. So, there's still question marks over when the volume and the mixed sales growth will return in the spirits industry.
Well, we'll pay close attention to that. I can guarantee you that. Duncan Fox, Senior Consumer Staples Analyst for Bloomberg Intelligence, just breaking down what we're seeing in the global spirits business. Had some turnover, senior management at Diageo, and just kind of getting the lowdown on that side of the consumer right now.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's go to the commercial banks. We've been talking to Alison Williams of Bloomberg Intelligence the past couple of days on the big money center banks, the big global investment banks. Now it's time to focus on the regional banks. And what I learned during a regional bank crisis a few years ago is the United States has about 5,000 regional and community banks around the country. I had no idea it was that many. I don't think Herman Chan follows all of them, but he follows a lot of them. Herman Chan, Bloomberg Intelligence Senior Analyst, he covers the U.S. regional banks. What are you expecting to hear from your banks this quarter? How is their business?
Right. So earnings season's kicked off today for a number of regionals. And what we've seen is just a resilient economy. Credit quality was really stable. A lot of the banks reduced their bad debt provisioning, so provisioning for credit losses. And that just shows that you're not seeing charge-offs really rise from here. Consumers are active in spending, and commercial borrowers are really transacting. They're preparing for tariffs, and you've seen an increase in lending activity because of that.
Now, when we look at local banks, I look at my local bank, and sometimes it seems like more of a billboard. I don't see it as so busy. I mean, talk about the trend of how these local branches are changing. I mean, some are cafes even.
Right. Yeah. Banks view their branches as a marketing ploy and really to help support their customers. One thing that they're doing is they're reducing the real estate footage within these branches, so that's helping reduce costs. But a lot of the regionals that I cover are really expanding as well. They're growing in new markets, particularly where the growth is, right? So I cover a number of Midwest banks like PNC and Huntington, and they're growing in the higher growth areas, in the Sun Belt areas. So that's something that we see ongoing and just changing the mix of the demographic growth for that companies.
How did the regional banks compete with private credit? A lot of the private credit funds that we talk to at least at the beginning, they started out targeting the mid-market,
right.
Middle-sized market companies, not like the big multi-gajillion dollar deals.
Mm-hmm.
But that's right where those regional banks like to play.
Right.
How's that competitive dynamic working out?
Yeah, it's been interesting. I would say that for a lot of the regionals, there's not a lot of direct competition quite yet. I would say the private credit folks are catering to a more riskier company. So, for example, we've taken a look at this a little bit, where the private credit companies are, you're talking about loan yields north of 10%, okay. Whereas the traditional middle market bank borrower is much more stable. So we're talking about 6-8% yield. So okay. It's a different company, but we do see private credit really will continue to encroach over time.
So you talked about some of the risks, some of the challenge that regional banks are facing. What are some of the things that they can kind of look forward to?
Yeah, really what a lot of the regional banks have talked about thus far in the second quarter earnings is there's some pent-up demand in lending, and that's been positive. Their customers are preparing for tariffs and really increasing their line utilization, which is helping commercial and industrial lending. And they've been really sanguine about the risk of tariffs, and we haven't seen really the credit quality deterioration that folks may have anticipated in April after Liberation Day.
Credit quality, specifically commercial real estate, there was concern that if there was going to be a problem in our financial system from some falling, particularly office real estate, that we'd see it in the middle-sized regional banks. Have we seen that?
Yeah, I would say that's an ongoing issue. Okay. We've seen losses continue, but they're manageable. Office commercial real estate, on average, for the companies that I cover in the large regional bank space, it's about 2% of their total loan portfolio. So it's manageable. PNC just talked about this earlier, just a few moments ago on their earnings call, and they said that charge-offs could rise in future quarters because of deterioration in commercial real estate, but they're already fully reserved for that, and they prepared for that eventuality.
Now, I cover a lot of different conferences here at Bloomberg, and one of them is with banks and AI. So how do regional banks, because they're not as big as the big banks, so where do they stand as far as AI and how much money they put into it?
Yeah, I view AI as a tool for the regional banks to continue to reduce their expenses. So it should help them in ways like reducing the employees in the cost center is one, where regional banks use chatbots and AI-powered chatbots to really help their customer base with in a more efficient manner, and things that are more human intensive. It could help reduce some of and streamline operations. Right now, it's more feeling it out. I don't think a lot of the regional banks have really jumped full board, but they are exploring ways to reduce costs over time.
All right, Herman Chan, thank you so much. We appreciate that. Herman Chan, Senior Analyst for U.S. Regional Banks for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.